welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Well, the US Fed has left rates on hold as expected. Here's Jerome Powell.
Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated.
Now, a notable difference in the latest policy statement is that the Fed has dropped a reference to making progress towards the Fed's 2% inflation goal, instead referring to the pace of price increases remaining elevated.
I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market.
The unanimous decision to keep overnight interest rate in the current 4.25% to 4.5% range puts the Fed in a holding pattern as it awaits further data and clarity on President Trump's policies.
I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy.
Well, US Treasury yields rose in response to the Fed statement, with traders pricing in fewer interest rate cuts this year. The yield on the 2-year note rising around 4.5 basis points to 4.25. The 10-year was up to 4.58. The US dollar firmed against most major currencies. The Aussie is trading at 62.3 US cents. Meanwhile, the central banks of Canada and Sweden delivered widely expected 25 basis point rate cuts. And Bitcoin jumped higher. It's currently just below 104,000 US dollars. Well, the Fed decision weighed on US stocks, which added to losses before recovering slightly after Jerome Powell spoke. Tech heavyweights, including Nvidia and Microsoft, led the losses. This was prior to earnings results after the bell. Microsoft reported slower than expected growth in its crucial Azure cloud business, despite beating estimates for overall quarterly revenue, sending its shares down 4% in extended trading. Meta beat estimates for holiday quarter revenue, signalling the AI-powered marketing tools were continuing to attract advertising spending across its social media platforms. The company reporting record revenue of $48.4 billion for the fourth quarter. Tesla's quarterly results fell short of Wall Street targets as financing offers and discounts failed to boost demand for its aging lineup, but eroded profit. The EV maker is saying it was on track to roll out cheaper vehicles in the first half of the year. Shares falling around 3.5% after the bell. IBM surpassed analyst estimates for fourth quarter profit, driven by demand for its high-margin software unit as businesses increased IT spending, setting its shares around 10% higher in extended trading. And Starbucks shares rose as it reported flat net revenue of around $9.4 billion in the first quarter of the fiscal year. Commodities were mixed. Oil prices falling to their lowest level since the beginning of the year after US domestic crude stockpiles rose more than expected last week. Brent crude futures more than 1% lower at $76 a barrel. Copper was up 0.8%. Iron ore around 1% higher at $104 a tonne. And the gold price slipped as the US dollar and bond yields rose in response to the Fed's policy statement. Well, let's get more on what we're seeing with a focus on the States. John Blank joining us from Zacks Investment Research. John, great to have you back on the show. Good to see you. Of course, let's start with that Fed decision as expected. What did you make of what we heard from Jerome Powell? I guess a subtle difference in that statement.
Yeah, Andrew, I mean, I got to put this into context of, him being in no hurry to adjust rates. They are going to cut rates according to their December projections, 50 basis points, sometime probably later in the second half of this year, 50 basis points in 2026, and a final 25 basis points in 2027. So the idea here is not that we are at their neutral rate and they think that we'll get to the steady state. They think we're going to get there very, very slowly and get it done by 2027. So what I struggle with right now in terms of what he said is he's looking to manage the risk on both the upside and the downside of their dual mandate of full employment and stable prices. But if you look at their projections, they're going to make no progress from 4.3% on the household unemployment rate for the next 2 years. and they're going to let the core PCE rate fall 2 to 3/10 of a point each year. And the question you have to ask yourself is, how is that going to happen? What pressure is going to happen, Andrew, to just bring it down? It doesn't naturally come down. And then, of course, everybody's, the elephant in the room is immigration policy if you tighten it. And if you tighten tariffs up and put them on a lot of sectors of this U.S. economy, that actually raises good prices, not lowers them, and raises wage push inflation, not lowers it. So this is the puzzle right now is I don't get the market forces that he thinks are going to deliver the lower inflation rate, and that's going to deliver the lower interest rates. And that's what we're going to ask ourselves, what's going on here.
Yeah. So, John, is the Fed in a bit of a wait and hold mode then on Donald Trump's policies, some certainty there, which may well dictate their next move?
That's absolutely the case, Andrew. I mean, I think that's the subtext here. They didn't call it out, but the uncertainty over tariffing, the amount of it, the extent of it, and immigration, when the line is drawn and saying, okay, that was illegal immigration, we dealt with it, but the legal immigration or the lawful immigration, or however we want to phrase those things or characterize those things, this is a nebulous subject and it does matter. So, I think anybody who's betting on a rate cut in the first half of this year is probably mistaken. I don't think the market is betting on it, but there is a potential if the data shows up in the core PCE for those 50 basis points in the second half. And that actually, Andrew, is getting some bid out of the financial stocks in particular.
Well, in fact, let's go there then, John, because you make the point, in fact, that those banks have pretty much led the way since the Fed began its easing cycle.
Yeah, that's it, Andrew. I mean, one thing we got to think about is stock investors. We're kind of in wave 3 of the boost in valuations coming out of this whole story. First of all, we got out of COVID and we had growth stocks, broadly, tech stocks in particular, and mega caps driving the market up. And then since the rate cutting cycle, it has been major banks that have been expanding their expansion margins and their profit margins. And one thing I was looking into, Andrew, we're talking about 3 number 1 ranked stocks, Wells Fargo, Morgan Stanley, and JPMorgan. You get a net margin on JPMorgan of 20% as a profit margin. That's impressive. So there's this share price. There's the story. You can see what we got the story now of the 2022, 23, 24 story built into these stock prices. So the question you have here, when our system says, like this shows you that everything's fairly valued, and it's an F for value and an F for growth, where is the share market's going to go from here to get the next level 10% interest in return? This is the question we're at right now is these major banks did lead us up the last, 6 to 9 months, but what gas is left in this trade? I frankly don't think there is any.
All right, let's take a look at Wells Fargo then. It's also on your list. What are you seeing there?
Yeah, well, the Wells Fargo is the one thing we need to talk about here. They've had, they were under a lot of pressure from the Federal Reserve to get their act together over some fraud that had taken place at the company and the previous CEO. They got a new CEO in, and they still are growing their way out of this situation. As you can see, this is a much lower share price, $75 versus $260 for JPMorgan. But what's interesting here is the price earnings ratio for this stock is down to 13, not 17. So this is the only one of the major bank stocks with a B, which means there's some value in the value in Wells Fargo. So the question here is, if the one trade you might want to make is to believe that the valuation expansion has a little more room to run with Wells Fargo than JPMorgan and Morgan Stanley.
All right. Well, let's just take a quick look at Morgan Stanley then, what you're seeing there as well.
Yeah, Morgan Stanley, one thing to note about this business is that this is 50% wealth management, and this ultimately is a third the market cap of JPMorgan. So what happens here is they've got a 13% profit margin, not a 20% profit margin. So what you notice here is, what does that mean? Well, it just kind of shows you how much slower and more sluggish the earnings were for this company. They really turned around their earnings, you can see, in early 2024. So for the wealth management business, which they relied on, they had to wait for that turn up until 2024. And we all know what that is, the stock market broadly, and basically the rate cuts. So what Morgan Stanley is an indication of, if your wealth management business is the core driver of your earnings, that's what lifted the stock, and that's what made Morgan Stanley rise to the level of these other two. That's what I would point out, that this is just kind of a mix issue for Morgan Stanley.
Now, John, of course, we're still in the midst of earnings season. Some of the Mag 7 reporting this week. We've just had Microsoft, Meta, as well as Tesla. And of course, this comes in the midst of that turmoil we saw earlier in the week, prompted by the release of the Chinese low-cost AI model in DeepSeek. So I guess investors, the market, looking at that CapEx spend in those AI-related tech stocks and then question the valuations.
Yeah, well, Andrew, I mean, the thing about Q4 numbers is these are backward-looking earnings reports that way predated the DeepSeek information, and we will get earnings outlooks and updates from covering analysts who are looking further for the outlook. So I would think this is a case where we really got to bother with the covering analysts on the back end of things, not as much what the CEO says, because the read-through is, how much do they need to interpret future CapEx spending on the base of the DeepSeek news and frankly the Alibaba news. So now, we got to basically wait for some expert opinions, I would say, in terms of resetting our expectations of where these stocks go.
All right, lots to consider. John, great to get across it all. Thanks so much for joining us from Zacks.
You bet, Andrew.
Let's focus on where we're likely to get going when the market opens in just a couple of minutes' time. So SPY futures, we're sort of waxing and waning between positive and negative there. So looking for a mildly negative start off the back of certainly what we heard from the Fed. And we will get right across that when we get going at 10 Eastern. Stay with us.